Imagine opening your portfolio and seeing steady cash payments landing in your account every single quarter. That's the beauty of dividend investing. Instead of waiting for stock prices to swing up and down, you're getting rewarded just for holding quality businesses. For many investors, dividends feel like the closest thing to turning the market into a paying partner. And in uncertain times, that kind of stability can be priceless. Today, we're diving into 3 dividend stocks that stand out this September, each with its own story, strong financial backbone, and potential to provide not only income now, but growth well into the future. If you've been searching for stocks that can build wealth through consistency, this list might be exactly what you need. The first company is Brookfield Asset Management. Brookfield isn't a household name in the same way as Apple or Microsoft, but it quietly controls an empire that stretches across real estate, infrastructure, renewable energy, and private equity. This isn't some small player trying to make a name. It's a global giant managing hundreds of billions of dollars. What makes Brookfield so compelling for dividend investors is its fee-based model. The company earns steady, recurring income from managing funds and investments, and as those assets under management grow, the fees pile up. More fees mean more earnings, and more earnings create room for larger dividend payouts. Brookfield has already signaled that it expects to grow its dividend at a rate of around 15% annually in the coming years. That's an aggressive pace, but it's grounded in real earnings growth, not just financial engineering. For investors, that means the dividends you collect today could be significantly larger just a few years down the road. Imagine getting a paycheck that not only arrives on time, but also grows consistently each year. That's the type of experience Brookfield aims to deliver. Beyond the numbers, the global reach of this company means it's diversified across industries and geographies. If one area slows, another can pick up the slack. For anyone who values both growth and resilience, Brookfield sits at the intersection of those qualities. Now let's shift gears to the world of industrial real estate, where Rexford Industrial Realty has carved out a niche that almost no one else can touch. Rexford specializes in owning and operating warehouses and industrial properties, but here's the twist. It focuses almost exclusively on Southern California. At first, that might sound risky. After all, why would a company put nearly all its eggs in one regional basket? The answer lies in supply and demand. Southern California is the tightest industrial market in the United States. There's enormous demand for warehouse space because of the region's ports, trade, and booming e-commerce activity. At the same time, land availability is extremely limited. You can't just roll out new industrial parks wherever you want, in Los Angeles or Orange County. That scarcity gives Rexford an incredible advantage. Its properties are consistently in demand, which translates into steady rent increases and long-term growth in cash flow. When analysts talk about embedded growth, this is exactly what they mean. Growth that is already built into the business model because of structural supply shortages and strong demand. For dividend investors, that means Rexford's payouts aren't just about where the company stands today, they're about where it's almost destined to go tomorrow. The dividends might not be sky high today, but the runway for increases is very real. Think of it like owning a piece of prime real estate that the entire logistics world is fighting over. You don't just collect rent, you collect rent that tends to rise year after year. That's the story Rexford offers. Finally, let's talk about Mid-America Apartment Communities, better known as MAA. This company is a real estate investment trust, or REIT, that focuses on apartment complexes in the Sunbelt region of the United States. The Sunbelt stretches across states like Texas, Florida, Georgia, and the Carolinas, areas that have been experiencing some of the fastest population growth in the country. People are moving there for jobs, better weather, and affordable living. Compared to coastal cities, that steady stream of new residents creates constant demand for housing, and MAA is right there to meet it. What sets this company apart is the scale of its operation and the quality of its properties. It owns tens of thousands of apartment units and has the financial strength to keep expanding. For dividend investors, the appeal is clear. Apartments provide reliable monthly rent checks, which flow up to the company and ultimately to shareholders as dividends. Unlike some industries that can swing dramatically with the economy, people always need a place to live. That makes rental income a relatively dependable stream. May pairs that dependability with growth potential, since the Sunbelt's population boom isn't slowing anytime soon. As more people move in, demand for apartments rises, rents increase, and dividends have more room to grow. For anyone looking for stability anchored by demographic trends, MAA checks all the boxes. Put these 3 together: Brookfield Asset Management with its global financial empire, Rexford Industrial Realty with its chokehold on the most competitive industrial market in America, and Mid-America Apartment Communities with its grip on the fastest growing housing regions. And you have a trio that combines income, growth, and resilience. Each one brings something different to the table. Brookfield is about global scale and dividend growth fueled by fees. Rexford is about scarcity value in real estate markets where demand will likely always exceed supply. MAA is about demographic trends and housing demand that simply doesn't go away. They're not the flashiest names in the market, but that's often the point. Dividend investing isn't about chasing headlines. It's about owning companies that quietly and consistently reward their shareholders. Now, before anyone thinks dividends are a magic bullet, it's important to remember that no investment is without risk. Brookfield depends on global markets continuing to expand, and while it has diversified assets, downturns in major economies could impact growth. Rexford, with its heavy focus on Southern California, could face challenges if regulations, taxes, or local economies shift significantly, and MAA, while benefiting from Sunbelt growth, could be affected by oversupply if too many new apartments come online at once. That said, each of these risks is balanced by powerful long-term advantages that have already been playing out for years. Smart investors don't look for stocks without risk. They look for stocks where the potential rewards outweigh the risks, and these three fit that description well. Dividend investing also shines when you think about compounding. Imagine reinvesting the dividends from Brookfield, Rexford, and MAA back into buying more shares. Each quarter, you'd own slightly more stock, which means the next dividend payment would be larger, and then the next even larger than that. Over 5 or 10 years, this snowball effect can turn modest investments into significant streams of passive income. It's like planting a tree that not only grows taller, but also produces more fruit each season. For many long-term investors, this compounding is where the real magic happens. There's also a psychological benefit to dividend investing. Market headlines can be noisy. Stocks are up, stocks are down. This company is missing earnings. That one is cutting jobs. It's easy to get caught up in the roller coaster of daily market moves, but dividends provide a counterweight. No matter what the market headlines scream, a dividend check arriving in your account feels like proof that your investment is working for you. That steady return helps investors stay calm and focused on the bigger picture, which is crucial for long-term success. As you consider these three companies, think about how they fit into your broader financial strategy. Are you building a portfolio aimed at steady income? Are you looking for growth paired with resilience? Or maybe you want diversification across different sectors. Brookfield gives you exposure to global financial assets. Rexford anchors you in industrial real estate, and MAA ties you to housing demand. Together, they touch three different areas of the economy, spreading your risk while keeping the focus on reliable dividends. Now picture yourself a year from today. Imagine you had invested in one or more of these stocks and had spent the past year collecting dividends quarter after quarter. Not only would you have that extra income, but you'd also likely have greater confidence in your portfolio's ability to weather whatever the market throws your way. That's the quiet power of dividend investing. It doesn't grab headlines, but it builds wealth steadily, brick by brick, payout by payout. For investors in the United States, the United Kingdom, Australia, and Canada, these names may already be familiar, but their appeal extends well beyond borders. They represent the kind of steady, shareholder-friendly companies that can form the backbone of a strong portfolio. Whether you're just starting your dividend journey or looking to add reliable new names to an established strategy, Brookfield, Rexford, and MAA are worth a closer look this September. So here's the takeaway. Dividends aren't just about cash. They're about building wealth through consistency and compounding. Brookfield, Rexford, and MAA have shown they can deliver, and they look ready to keep rewarding shareholders. If you want steady income with growth potential, these three are worth watching.